Hey friends, welcome back to the channel. I've got a new desk set up as you can see here. I hope you like it. Now in today's video, I'm going to be talking about the housing market and why I still believe the toughest challenges are yet to come for this sector. I've got a lot of data and signals to share with you today. If you're new to my channel, make sure to subscribe, turn on the bell, and join me on Substack below for more, where I talk about US and China investment strategy. Now, let's recap the consumer and big picture macro. We can see here that home prices have actually risen this year despite the high inflation and hawkish Fed rhetoric that we've seen throughout the year. And we're seeing the US Consumer Confidence Index jump to the highest level since early 2022. And because of this, many regions in the US, home prices are actually ticking higher. Now, in my opinion, the biggest bubble is actually not in stocks. The biggest bubble that I see right now is in housing. Why do I believe that? That's because the income to house price ratio is essentially at multi-decade lows, and affordability is extremely difficult for a lot of millennials and Gen Z, which makes me believe that the only people that can really participate in real estate right now are investors or very well-heeled individuals. So people think that the housing market is strong, but I personally think it's not strong at all. It's illiquid. That's what's keeping prices high. I've got a lot of data to share with you today. Let's take a look at this chart here. It's the supply of housing inventory. We can see that it's tighter than ever. In fact, the number of homes for sale drops now to the lowest level on record. This is artificially keeping prices high. It's not because there's a lot of demand, it's because the supply is extremely tight. And because the mortgage rates now are north of 7%, and depending on your credit score, could get close to 8% for the 30-year, the market is actually becoming more and more illiquid, where there are fewer sellers on the market and fewer buyers at certain price ranges for residential. Now, if we take a look at this table here, this was back in May 2023, just a quarter ago, we can see that new listings, they're actually falling at a very rapid pace. And this is the metric that we should follow because this is constraining the prices from falling further to make it more affordable. Now, there is an optimistic and contrarian view about why the real estate sector continues to stay supported despite all the data that says that it should go lower. This is because some economists think that when rates fall even slightly, there could be a surge in buyers to make inventory even more limited. If we take a look at this chart, nearly half of home offers faced bidding wars just a quarter ago. That's pretty significant, even though the economy in the US is softening. And because of these robust cash offers, it continues to be one of the biggest barriers to affordable housing. We can see here that 1/3 of US home purchases were actually made in cash about a quarter ago, earlier this year. And because of this, housing prices are actually ticking higher and rebounding from the decline that we've seen so far, and this could reignite inflation concerns later this year and in 2024. Now, if we dissect the housing market, the best performing part in housing is the modestly priced residential areas. So the lower priced homes across the US, those are the areas that continue to be resilient. All other price ranges, many other price tiers within housing, especially if it's north of 500,000, those homes are having much more difficulty selling depending on the neighborhood. We can see from this map that neighborhoods like Rochester, Hartford, Portland, Worcester, Allentown, these neighborhoods within the states on this map, these are the neighborhoods that continue to sell well because those homes are selling at modest prices. Now, with the 30-year mortgage rate now rising above 7%, and depending on your credit score, reaching 8%, I believe that this market is becoming more and more illiquid. So be careful if you are a first homeowner and be a smart consumer. We can see here that Elon Musk talked about commercial real estate melting down fast and that home values are next. Now, before we continue, I want to give a shout out to YCharts, the data provider for my channel and my community, for their support. So here's what they have to say. Letters from Larry, which is my Substack publication, is brought to you by our friends at YCharts. Ever wish that you could see the impact of your investment plan in action? Well, look no further than YCharts. YCharts released their new scenario builder, enabling users to run real-life scenarios, show the impact of withdrawals and contributions, and share better recommendations with clients and prospects. Its latest enhancement allows advisors to upload scenarios into their custom reports for even more streamlined meeting prep. Check out the Scenario Builder's newest updates with this link or start a free trial with them to see for yourself. So thank you to YCharts for partnering with my channel and giving us the data that we need to make good decisions. Now let's talk about real estate investors. And I want to show you some data and helpful psychology behind a major force driving housing values in residential. This is going to be eye-opening. Look at this chart here. Investors, they own 1 out of 10 homes for sale. That is substantial because that means investors have a very big impact on housing prices going forward. We can see that investor market share in terms of the percentage of total home sales in which an investor was the buyer was 18% in the first quarter of 2023. And we can also see that investor activity has tapered down significantly this year from prior years. This is important to realize because if this activity continues to decelerate, there is a very good chance that housing prices will fall later this year and in 2024, especially once supply ticks up. We can see investor purchases are really starting to tick down in 2023, and investors are also forced to target affordable properties, not properties across the entire price range. They're really focusing on the affordable properties. Now here's an important signal to watch, and this is key. Watch for investors and their activity to stop buying residential. A lot of realtors are saying that once investors pull back from the residential market, it's likely that there's going to be a lot less bidding wars and sellers will have a much harder time trying to sell their houses above their list price. Now, we can also see from the data that low price homes make up nearly 1/2 of investor purchases. And 2 in 5 homes bought by investors are starter homes. This is actually rising to a multi-decade high. This is why housing feels so unaffordable, because even in the affordable sections of the market, we're seeing investors come in and swoop in and use all cash offers to buy those homes. But it hasn't been an easy ride for investors across the board. We can see here that investors are most likely to sell at losses in cyclical areas, areas that have risen substantially since the pandemic because of their low inventory supply. Areas like Phoenix and Las Vegas, these are areas that investors are actually losing substantial amounts of money in. And if investors have to cut losses in those regions, there's a good chance that they may pull back in other regions as well as liquidity dries up. Now we can see here that in Phoenix, investors lost money on 30% of homes they sold in March. And this may continue to go higher as mortgage rates stay stubbornly high above 7%. Now let's talk about renting versus owning a home. I know a lot of us want to own a home and we're constantly debating whether we should rent or whether we should own. So we can see here from this chart that in most cities in the US, it is now far more affordable to rent. There is a huge premium to pay the mortgage versus the rent, especially after you account for property taxes, maintenance costs, and operating repairs. There are also some secondary signals that we should watch for in the real estate market, and this is the investor activity for Airbnb and VRBO. Allow me to explain. We can see here that there are private equity and public funds such as Invitation Homes that actually go out, buy homes, rent them out, and they are buying those homes for tourists only. Essentially, they're using it for Airbnb and VRBO type of activity. Why does this matter? Because these homes are now pulled out of the supply, the inventory. They're not available for people to live in, and it's only available for tourists. And because of this, the supply of the inventory actually goes down, and that drives housing prices in that neighborhood to go higher. We can see how important investor activity was based on the data I showed you earlier in this video. Now, if these investors start dumping these Airbnb and VRBO properties, what's going to happen is that the supply of homes in these neighborhoods will then rise, and therefore that's going to cause pressure for home prices in that region. So this is another signal that we can watch for the impending correction that I'm expecting in the real estate sector later this year and in 2024. We can also see that the activity for house flipping is also rapidly slowing down. And because home flippers aren't reaping the gains they used to, they're forced to sell homes at losses after deducting for operating costs and property taxes. These housing speculators, they're on the hook for operating expenses, and if they can't offload them fast enough, this could create problems for real estate investors going forward. Now, here's my opinion, and of course this is not financial advice, but I think that now is not only a bad time to get into housing, to buy your first home, it's probably the worst time, unless you are an all-cash buyer. In that case, your circumstances are different. Because once the unemployment rate goes higher, the housing market will transform from an illiquid to a potentially declining asset class as supply of homes goes higher and the ability of people to enter the market actually declines with joblessness increasing. So it's time to get cautious in housing, and it's definitely not an area that I think is promising over the next 6 to 9 months. With that said, I hope you enjoyed the video. Thank you for your support as always. Make sure to join me on social media on the other platforms, Threads, Twitter, Instagram, Substack, and I will see you guys in my next video.